Welcome to today's deep dive. If you just glance at the broader market numbers for today, Monday, July 6th, 2026, you might actually walk away thinking we just had a fairly mundane start to the week.
Yeah, it really does look that way on the surface.
Right. But when you peel back the layers of the source material we are looking at today, you see a completely bifurcated reality. For you listening, our mission today is to dig into that split screen.
It's a profound divergence, honestly.
It really is. On one side, we have this hyper-accelerated, high-definition silicon boom where wealth is just being generated at warp speed. And on the other side, a very tense, gritty reality of shifting global geopolitics, industrial drag, and consumer base caught in a massive psychological contradiction.
Exactly. I mean, the broader market just isn't lifting equally. You look at the Nasdaq Composite, and it gained 1.3% today.
Which is an absolute tear.
Oh, massive.
Yeah.
And the S&P 500 rose 0.7%. But both of those are heavily driven by highly targeted technology components.
Right.
Meanwhile, the Dow Jones Industrial Average completely flatlined. Legacy companies are basically acting as an anchor. It's creating this market where the average stock is effectively standing still, while a select few are reaching escape velocity.
Okay, I want to start by looking inside the hardware driving that escape velocity. Because, to understand the Nasdaq's massive jump, we really have to talk about the semiconductor sector. It is a full-blown gold rush right now.
It is. I mean, AMD surged a massive 8% today.
8% in one day.
Yeah, and the trigger was a Japanese autonomous driving startup called Turing. They announced they are using AMD graphics processors for their AI training.
Okay, my initial reaction here is a bit skeptical, to be honest. We all know NVIDIA has an absolute stranglehold on AI training, right?
Right.
Largely because their CUDA software ecosystem is just so deeply entrenched. So how is AMD convincing a bleeding-edge autonomous vehicle startup to defect?
That is the multi-billion-dollar question, and it really comes down to the specialized demands of the edge compute environment versus the data center.
Okay, unpack that a bit.
Well, you mentioned NVIDIA's CUDA mode. In a massive centralized server farm that's training a large language model, that moat is nearly impenetrable right now. But autonomous driving operates under totally different constraints.
Because it's happening in the car.
Exactly. A startup like Turing is looking for hyper-specific optimization for machine vision. They need real-time decision-making where, frankly, latency is a matter of life and death.
Wow, yeah. The car can't wait for a server to tell it to brake.
Right. So AMD has been aggressively courting these niche high compute applications by offering more open source flexibility and better pricing leverage. For the market, this 8% jump isn't just about the revenue from one Japanese startup.
It's a proof of concept.
Exactly. It signals that NVIDIA's armor actually has a gap when it comes to specialized, non-text-based AI applications.
So the compute market might be fragmenting naturally, like that monolithic dominance we saw from NVIDIA over the last 3 years might be breaking up into specialized territories. Because you also have Broadcom jumping almost 4.4% today on news that they extended their massive chip supply deal with Apple.
Yeah, that was a huge mover today.
But the timeline is what stops me in my tracks.
Yeah.
The deal goes all the way through 2031. In the tech hardware world, a 5-year contract feels like a century.
It does. And it implies a staggering level of anxiety within Apple's supply chain operations.
Anxiety. Really?
Oh, absolutely. Apple does not like to be locked into long-term vendor dependencies if they can avoid it. They usually prefer to play suppliers against each other to drive down costs.
Right. That's their classic playbook.
Right. So the fact that they are committing to Broadcom through 2031 tells you they are forecasting a severe, prolonged bottleneck in advanced networking and radio frequency chips. They aren't just paying for raw silicon, they're paying for certainty in an increasingly fragile global supply chain.
So if Apple is terrified of running out of runway, the rest of the tech sector should probably be paying close attention.
Very close attention, yeah.
I want to throw Intel into this mix because their movement today was equally surprising. Intel leaped 5.3% after Frank Lee, an analyst at HSBC, doubled his price target to $200.
Doubled it. That's a massive revision.
Huge. And his thesis hinges on explosive demand for CPUs and PCs and AI inference services. Now, I understand the broad concept of inference, like the AI actually doing the work rather than just learning. But I struggle to see how Intel beats NVIDIA or AMD to the punch on the consumer desktop.
Well, you have to look at the architectural shift happening in personal computing. For the last few years, all the oxygen in the room was consumed by AI training.
Right, feeding petabytes of data into massive server clusters.
Exactly. That is NVIDIA's territory. But the next phase is inference at the edge, meaning running those models locally on your laptop without needing a persistent, high-bandwidth connection to the cloud.
Okay, so you don't need a massive data center just to draft an email.
Right. You don't need a $40,000 H100 GPU to summarize a PDF or generate an image locally. You need a highly efficient neural processing unit, an NTU baked directly into the consumer processor.
And Intel already has the footprint there. I mean, they are the standard in corporate laptops.
They completely own the enterprise PC footprint. Frankly is looking at a massive corporate refresh cycle. Think about it. Companies bought laptops in 2020 and 2021 during the remote work boom.
Oh, right, during the pandemic.
Yeah, and those machines are aging out now. As corporations look to upgrade, they want machines capable of running local AI models to keep proprietary data off public clouds. Intel is perfectly positioned to capture that upgrade supercycle.
By offering chips optimized for local inference.
Exactly. The pie is getting larger because the nature of the compute is moving from the server farm right to the office desk.
Okay, let's follow that capital flow.
Okay.
We have all these tech giants buying the chips, building the servers, and prepping for this AI integration. Microsoft is set to release its Q4 earnings on or about July 29th, and the market is hyper-focused on Azure and their AI investments.
As they should be.
Yet, concurrently, Microsoft is cutting 4,800 jobs. I look at this paradox and I have to ask, if AI is genuinely creating all this unprecedented value and opening new markets, why are the most successful AI companies aggressively shrinking their human footprint?
It comes down to a brutal reallocation of capital, specifically from OpEx to CapEx operating expenses to capital expenditures.
Okay, explain that shift.
Building out an AI-capable data center is a fundamentally different financial beast than building a software product. In the Web 2.0 era, a company's biggest asset and its biggest expense was human engineering talent.
Right, hiring thousands of developers.
Exactly. Today, the biggest expense is compute. The sheer volume of capital required to purchase those NVIDIA and AMD chips, secure the energy to power them, and build the physical infrastructure is in the tens of billions of dollars.
So they're essentially trading human capital for compute capital.
Yes. They're looking at their legacy departments,
Right.
you know, the software divisions that aren't growing at 30% year over year, the middle management layers, and they are cannibalizing them to feed the Azure cloud infrastructure.
Wow.
Those 4,800 jobs aren't being eliminated because Microsoft is cash poor. They're being eliminated because every available dollar is being funneled into winning the AI infrastructure war. And the market rewards this because it shows a ruthless commitment to future dominance over current comfort.
But the capital isn't solely flowing into silicon. I noticed a fascinating outlier in today's M&A activity. A private equity firm called Versant is buying a golf simulator company full swing for $530 million.
$500 million for golf simulators.
Yeah, it's wild to see $500 million flowing into high-end leisure while Microsoft is restructuring for a digital arms race.
Well, if we connect this to the bigger picture, it highlights a massive divergence in the consumer economy. Private equity is betting that a specific echelon of the consumer base, the high net worth demographic that buys premium home golf simulators, remains completely insulated from broader macroeconomic pressures.
Which is a stark contrast to what the rest of the consumer base is facing today. Let's pivot and look at the traditional economy, because the anchors dragging down the Dow are telling a very different story.
They really are.
We saw Honeywell drop 7.2% today and Amgen fell 2.6%. We are seeing industrial supply chains and traditional healthcare taking a real hit. But the most interesting data point to me is consumer behavior.
Right, the student loan updates.
Exactly. Student loan servicers are now sending out alerts that borrowers have exactly 90 days to leave the Biden-era SAV plan. Just to be clear to you listening, we are neutrally reporting this as a market driver, not taking any political sides here. But financially, we are talking about millions of people facing a sudden, severe contraction in their disposable income.
It's a huge shift. The resumption or restructuring of those debt obligations is a massive macroeconomic headwind. In a rational economic model, a consumer facing a looming financial cliff in 90 days will aggressively contract their spending.
They'll hoard cash.
Right, they will hoard cash, cut discretionary expenses, and brace for impact.
But they aren't. Despite that looming cliff, and despite record-breaking global heat waves, we are seeing an unprecedented off-season boom in international travel. Airlines are actively extending their flight schedules just to keep up with the demand.
It's totally counterintuitive.
I look at this and it defies basic financial logic. How do we reconcile a consumer base that is drowning in approaching debt, yet still braving extreme heat to vacation in Europe?
We are witnessing a shift in behavioral economics. It's often referred to as doom spending, or really just a permanent change in experiential valuation.
Doom spending. Okay, what drives that?
Well, for a significant portion of the demographic holding that student debt, traditional financial milestones like purchasing a home in a high-interest rate environment feel structurally out of reach. When long-term asset accumulation feels impossible, the psychological value of future savings drops to near zero.
So the logic becomes, well, if I can't afford a house anyway and inflation is eating my savings, I might as well buy the plane ticket.
Precisely. It is a rationalization of immediate experiential gratification in the face of long-term financial pessimism. The post-pandemic revenge travel never really ended. It simply morphed into a coping mechanism for economic anxiety.
Wow.
It is a highly fragile state for the consumer economy because it relies on spending momentum that is completely disconnected from underlying wealth generation.
And it is all happening against a backdrop of severe international fragility. The geopolitical reports today are heavy, and they are directly moving markets.
The global stage is incredibly tense right now.
It is. We have former President Trump holding calls with Russian President Putin and Ukrainian President Zelensky. Again, keeping our neutral lens here, we're just looking at the market impact. Because concurrently, the conflict is escalating on the ground, with Ukraine striking Russian targets and Moscow launching a deadly attack on Kyiv. We also have the U.S. ambassador to NATO describing current tensions within the alliance as growing pains, directly related to pressure on allies to boost defense spending. As someone trying to parse the market, I have to assume this level of diplomatic and military unpredictability is just a nightmare for institutional investors.
Oh, absolutely. Markets fundamentally price risk based on predictability. Standard diplomatic channels and established alliances offer a predictable framework.
Right, they know what to expect.
Exactly. When you introduce direct, highly individualized diplomatic interventions outside of those channels, coupled with active, escalating kinetic warfare, the models break down. The market isn't making a value judgment on the politics of the calls. It is pricing in the sudden influx of variables.
So how does capital react to that?
Institutional capital responds to unpredictability by seeking hard assets in sectors that benefit from prolonged instability.
Which actually makes total sense of our last major piece of source material today. I was initially struggling to see how a multi-billion-dollar defense acquisition fit into a day dominated by AI chips and consumer debt.
The Lockheed deal.
Right. Lockheed Martin is buying naval defense firm Ultramaritime for $3.45 billion. At first glance, advanced underwater acoustics and anti-submarine warfare feel entirely divorced from Silicon Valley. Are we just throwing these into the same discussion because they happen on the same Monday, or is there an actual through line here?
There is a very distinct through line. Both the technology sector and the defense sector are engaged in massive infrastructure build-outs to prepare for a high volatility future.
Okay, how do they connect physically?
Well, you mentioned Ultramaritime specializes in underwater acoustics. Think about the physical infrastructure of the digital world we just spent the first half of this discussion analyzing. The data centers running Microsoft's Azure, the AI models being trained on AMD chips, they all rely on transoceanic undersea cables to transmit data globally.
Oh, wow. So naval defense is essentially the physical security for the digital cloud.
It is the bedrock of it. Furthermore, you cannot separate the semiconductor supply chain from the geopolitical reality of the South China Sea and Taiwan.
Right, because that's where the chips are made.
Exactly. Lockheed Martin doesn't deploy $3.5 billion in capital unless they foresee a generational, sustained demand for advanced maritime capabilities. They are looking at the exact same geopolitical instability, the pressure on NATO to rearm, the unpredictability in Eastern Europe, and they are consolidating the assets necessary to supply that demand.
It paints a fascinating, almost daunting picture for you listening today. If you want to extract the ultimate signal from July 6, 2026, it is that capital is fleeing the comfortable middle and rushing toward the extremes.
That's a great way to put it.
On one side, you have the digital extreme, right? A silicon arms rush where companies like Apple are locking down supply chains through 2031. Intel is trying to put AI inference on every corporate desk. And Microsoft is sacrificing thousands of jobs to build the compute infrastructure of tomorrow.
And on the other extreme, you have the physical reality. A consumer base engaging in fatalistic spending while facing a massive debt cliff. And a defense sector quietly consolidating naval assets to prepare for a fundamentally unstable geopolitical decade.
It's the ultimate split screen. But the more we dissect it, the more those screens seem to bleed into each other. We started by talking about AMD powering autonomous driving teaching machines to navigate the physical world independently. And we end with Lockheed Martin building out next-generation autonomous naval defense.
Which leaves us with a critical question to consider going forward. We currently treat the technology sector and the defense sector as two distinct pillars of the market. But as AI systems achieve true autonomy, and as warfare increasingly relies on advanced silicon and machine learning rather than traditional munitions, well, how long until that distinction disappears entirely?
That's a chilling thought.
At what point does Silicon Valley and the defense industrial complex merge into a single, unified driver of global capital?
When the companies building the AI are the exact same companies securing the borders, it is a profound shift to watch unfold in real time. Thank you for joining us on this deep dive. Keep examining the broader trends, keep questioning the narrative behind the numbers, and we will be right here next time to help you make sense of it all.